Well, welcome back to the New Zealand Property Podcast and Video Series, kindly sponsored by my good Harcourt's Property Ventures team here at Alexandra Park, and a very special guest today, Nick Goodall from CoreLogic. Welcome, Nick.
Good, Mark. Thanks for having me.
Yeah, a pleasure. And I saw Nick speak a few, well, probably a month ago now, actually, at an event, and I've always sort of like hearing you online, but it was nice to hear you in person for a change. So, Nick, just so people know who you are, you work at CoreLogic. What's your role there? I noticed today you've been there for 13 years, so you must like it, or they like you, or something.
Yeah, I guess it's a bit of both, hopefully. Yeah, head of research here at CoreLogic these days. I've probably been in that role for, I don't even know, maybe 6 or 7 years. Previously an analyst in the research team, and so they had that normal progression. And as the research team, there's myself and our economist, our property economist, Calvin Davidson. And between the two of us, I suppose the role of the research team here at CoreLogic is to gather all the information we can. That's both using CoreLogic data and external sources of data, and really tell that story about what's happening in the property market and taking that to market to essentially anybody that will listen. You know, we educate internally to ensure that our staff can have those conversations with clients. We obviously deal with the media, so we do a lot of media work, and then we'll deal directly with those clients, whether it's at conferences or direct into internal meetings at banks or real estate agencies or brokers, whatever it might be, and just help them to understand that property market. And, you know, a big part of that role is also trying to uncover new ways of looking at data. You know, we've got so much of it these days, particularly at CoreLogic. I get that chance as a analyst by trade to just go and play with the data, see what's new, what correlations we can find, what sort of derivative forms of data we can see that might tell us more about the property market today than we knew yesterday. So yeah, pretty exciting one. And that's sort of kept me here, I guess. And yeah, really, really good business, obviously, supporting lots of different industries, keeps it interesting, and met lots of cool people as well. So yeah, certainly really enjoy the job, that's for sure.
Right. No, that's great. And geez, I tell you what, the hardest thing from the real estate perspective is data. Is there's so many different ways you can do data, and for us to the CMAs, the appraisals, and they're no one's equal. They're all different, and they've all got up to date data, and some of the data is quite old, and it's just like I don't want to pick on any external people today. But there's one for example that a lot of people use, the public use. It's free data, but it's old and it's been off for the last 2 years. And the data we use has been pretty damn accurate the last 2 years, sort of thing. So your data just comes from the actual source of. So if a place sells, you hear about it immediately pretty well.
Yeah, that's right. I mean, we've got multiple sources of data, and I guess that's a big part of our business, is having a really strong data acquisition team to go and find any forms of data from any source possible, whether that's listings agencies, whether that's listings portals. The council data, of course, is the official source, but does come a bit later. We've got recent sales calling programs, so we can go and get that data as soon as a property is sold. You know, we have all the official LINZ title transaction data. We're now accessing hazard data as well. So we do kind of have all these different sources, and that's, I suppose, the job of CoreLogic. You know, we're a property data company. We're about bringing that stuff together, matching it well, serving it up nicely, and then delivering it to any client, whether it's a telco or a bank or a real estate agency, any organization that needs property data to help make smarter decisions. That's who we're trying to help out. And it's really about how we can bring the data together, cleanse it, serve it up nicely, and help them to do their job better or serve their clients better in many cases as well. So yeah, that's certainly a core part of what we do, and got massive amounts of teams that are there to support it. One of the things that's probably, we should probably talk about more, that's least understood, is that we actually support fire and emergency here in New Zealand. So we've got a data quality team here in Wellington, where I'm based, and they're constantly just looking at aerial imagery and making sure that all the data makes sense. So if you call 111 and you need an emergency vehicle to get to your unit in a rest home or a property, that you're not just getting the address point, which is where the driveway is or where the letterbox is. It's actually that unit, the XY coordinate on that parcel of land to get to exactly where you need to get to. So, there's some pretty important data sets there, and some pretty important things that go on. And timeliness, accuracy, those are really, really strong pointers for us. And if we don't have that right, then our clients can't do their job. So yeah, it's a pretty important one for us.
Okay, awesome stuff. As I just mentioned at the opening, I heard you speak at the New Zealand Real Estate Conference, a new event this year, and like a typical bloody economist or someone talking like an economist. Well, I wasn't deaf by PowerPoint, but usually it is. But what I really liked on what you did, there was one slide in particular, and because you can have so many different ways of looking at things, and you love this stuff, right? That's what you do. And I like this one graph, and it was sort of the type of I wrote down here, it's a different type of buyers graph over the previous years and where things are now, as in the movers of people who are moving home, or moving town, maybe the first home buyer versus the investor, versus new people to the market, first home buyers. So that was a really good. I love people to hear a bit about that. And yeah, if you can just talk to that, I'm not sure if we can put an overlay or something when we make this live. But yeah, if you could, that was interesting. So over to you, mate.
Yeah, absolutely. Yeah, as I say, hopefully not death by PowerPoint, but certainly death by charts and numbers. We'll throw a lot at you. And yeah, I know that takes a lot of, people will have to take the slides away and sort of time to consume that because we do throw a lot at people. But yeah, that's absolutely one of our CoreLogic data sets. It's one that we created back in 2013. We call it our buyer classification series. And a little bit of history to this data set or data series is that back in 2013, you'll remember, the loan to value ratio rules were being discussed. They weren't currently in place. They were being discussed. And the whole conversation at that time was that they will really significantly affect the first home buyer market. But at that time, no one was measuring first home buyers whatsoever. There was no one in the market that did that. Reserve Bank weren't tracking those loan purposes. There was just no one doing it at the time. And that's when we went through this exercise to say, well, surely we can use the names on titles and say, if we've never seen this name before, that's a first home buyer. They've bought the property for the first time. So that's always been the core reason for that series. That's the main focus for why we put it together. But of course, as we were creating that, we could also look at it and go, well, actually, we can see where someone's moved house. They've sold a property and bought a property within 6 months. We could call them a mover. Similarly, we can look at multiple property owners. Now, we don't know if they're investors or they're just someone that owns a holiday home, but we can call them multiple property owners and we can allocate them to a group as well. Now, again, there's real complexity here, right? With with classifying names, name duplication, multiple people on title. So we know it's not perfect, but for an analyst like myself, it's all about the trend change over time. And one of the things we identified straight away was that back in 2013, first home buyers were around about 23% of the market of purchases, and they dropped about 2 or 3% as soon as those loan to value ratio rules came into place. They did affect them straight away because every single first home buyer, or pretty much everyone, needed a 20% deposit, and not all of them had that, of course. But it slowly took time before first home buyers worked their way back into the market. Now, whether they were big borrowing or stealing to get that 20%, or the banks obviously had their limits outside of that, first home buyers came back into the market that adjust their expectations and they worked their way back. And we're sort of seeing that over the last 10 or so years, they've continued to stay relatively strong in that 23 to 25% mark. And they've actually increased a little bit more recently. So we're seeing them sort of pick up about 26% of sales throughout most of last year and also throughout the last quarter of data as well. So that's the third quarter of this year. We also classify, as I said, multiple property owners. We've started to see them inching back into the market. And when you look at the monthly version of this chart, we've seen them slowly work their way back into the market since April this year, when they were sort of a couple of percent lower. And then they picked up about 26% of sales in September 2024. So we're seeing investors coming back in as regulation has improved. We know loan to value ratio rules have loosened up. Of course, you can write off your interest costs again. All these changes the government have brought in, bright line test shortened, that's sort of bringing the investors back out of the woodwork. And we expect that to only grow further now that interest rates are actually starting to fall, because maybe some of that was in anticipation of the interest rates falling. Now they're actually falling. We expect that to flow through to the bottom line for investors, and they will come back into that market as well. And on the flip side of all of this, it's the movers that really haven't been quite as active recently. We know that in the last couple of years, they've struggled to get bridging finance. Obviously, it's a bit of a tough market to buy and sell in. Do you buy first? Do you sell first? What if you get stuck with two properties at high interest rates? So there's been a lot of uncertainty for those movers, less desperation for them to move to that next home or downsize or upsize or move to a better region or a better suburb. So they've just held back from the market. And I suppose there's one other viewpoint from that you could take, which is, maybe there's some pent up demand to come from those movers once they have more job certainty, we get through this difficult period of the economy, and they might start to come back out from the woodwork. Maybe into next year, interest rates will be falling, and maybe they'll feel more comfortable to get back out there and look at upgrading that house where they maybe haven't previously. So yeah, look, it's an intriguing data set. It's all about the change over time, not necessarily pinpointing exact number of sales or proportion of sales, but yeah, we find it really useful. The intrigue that you've had with it is a pretty common one we find when we present that to a number of different clients. And yeah, we find, great use of it, and looking at regional or different property types, and you can kind of cut it any which way because it's our own data set. So that's huge for us.
And Nick, have you got any of those figures right in front of you at the moment, or just sort of the property investor one? I'd just be intrigued for that over the last sort of 3 years, how they've gone up or down sort of thing compared to what I've seen in the market, because they certainly just seem to be coming back in now more and more, which maybe the data's not even there yet. I'm not sure.
Yeah, no, I think we have seen very similar trends to what you talk about. We obviously saw investors really struggle to make the finances work over the last couple of years. As interest rates have increased, we know those mortgage top-ups have been higher for those property investors, and so we haven't seen them as active. But as I said, from April to September this year, they've inched their way back. It's pretty small, and that's on a monthly basis, so it's slowly coming back. That longer term trend is still relatively flat. And when you look at it over a longer period of time, and this is at the New Zealand level, by the way, so we're not we can go at different regions, but this is a New Zealand level. I don't have it right in front of me, but I can certainly supply a chart for, like, say, post-production, throwing it in there. They've been upwards of 27, 28% of sales at different periods of time in the market, particularly through COVID. We know the loan to value ratio restrictions were taking off. Interest rates were really low. If you could, essentially, you were encouraged, by any which way to get into the property market as an investor if you could. And we saw activity increase significantly off the back of that, up around about that 27, 28, 30% mark. Down now, got to as low as, I think, 22%, but slowly creeping their way back into that market. So yeah, look, it's been one of the ones that's changed dramatically in probably the last 4 years, if not longer. And it is now sort of set for that growth back into the market.
Yeah, absolutely. And yeah, the movers is also just a really interesting one, because that's the one, I've heard Brian Thompson, the CEO of Harcourts, a couple of times in the last year, and he's saying about, New Zealand needs so many sales a year for it to function, because people have to move, people get divorced, they die, people, immigration, whatever. So the move has to happen, and because those triple CFA rules that come in that stopped lending pretty well overnight, for a year or so, it just was dived down, and it was below what New Zealand needs to run as a country, sort of thing. So I guess we have seen a bit of that in the last 6 months come back. We dip at the start of the year, and that is coming back and probably come back more. So that move is one I can sort of see be making up a bit of those sales, which is good, and we've certainly noticed a whole lot more sales in the last couple of months than we have from a year and a half ago. So that's great.
Yeah, I mean, those sales volumes, like you say, have been, very, very low. I think, we got as low as 60,000 sales in a year. And, that's pretty much as low as we've ever seen over a number of decades. And then when you compare that to the dwelling population, it's as a proportion of total dwellings, it's probably the all-time low. And so we know we come off a very quiet period. We are expecting things to increase from this time onwards, but it's still pretty gradual. And I think while things are turning around and there's improvement to come for the market, both in terms of transaction activity and value growth, it'll be pretty slow to start off with, I think, because we've still got a number of things that are just going to contain that growth as we move through this next phase of the market, really.
Yeah, because I got told, I'm not exactly sure of the number, I think it was about 90,000 or 85,000, was somewhere in that figure that New Zealand need to have to maintain, as I was talking about before, normality of people's lives, what's going on, how many sales we need, sort of thing. And it's a really important part that a lot of people don't think about property, I think. And I guess the most obvious example of that we've ever seen was COVID, when we got locked up for 4 months and there were no sales, or very, very few sales. And guess what happened afterwards? We had the most unhealthiest, biggest spike we've ever had, because people just had to move, they had to buy, they had to sell, so all those things happen. So it's a really important that I'll be certainly looking at in the in future decades, hopefully.
Yeah, no doubt. And I think the interesting thing when you look at that is that when people talk about, oh, there's few transactions, and they sort of, poor old real estate agents, they're not selling houses. I think it's, and there's a bit of tongue in cheek, of course, with that. But I think the thing that people forget is just how many other industries are reliant on the real estate market turning over, whether it's movers, there's a lot of different industries, of course, banking and finance, insurance, real estate, but there's a whole bunch of other smaller industries as well, which are tacked onto the side of it. So it's actually one of those things that's quite a strong contributor, maybe not directly, but indirectly as well to our economy. And that, yes, of course, the more transactions that are occurring, the more activity that's happening around houses, then it's going to be assisting a number of different people in their work, because there's so many sort of associated jobs and associated industries attached to the housing market, not just those that are directly involved, like real estate agents or banks who are doing the mortgages themselves.
Yeah. Great. Rightio. OCR. We can't talk to you about the OCR, otherwise people will shoot me. Now, so and of course, this is all as the whole thing is. It's just you talking, not you're not representing CoreLogic or any of those things. The big disclaimer. So OCR obviously has been big news in the last sort of 2 months, and I've seen it directly affect the market as soon as they even spoke about it happening. But from you sort of thing, has it made a difference to the market? Some people could say, well, hey, the prices haven't gone up yet, and there's very good reasons for that. But what was your take on the OCR, and obviously the potential 0.75 we're all picking that's going to happen in a few weeks' time?
Yeah, look, I think the initial thing from any change in the OCR is the change in confidence. We've seen straight away the announcements of the OCR flows through to demand coming out, right? People going and talking about what are their options. Can I buy a property if I'm a first-time buyer? Can I move house, now that the OCR is going to fall? And they're confident in feeling more wealthy, I suppose, knowing that probably if they secure a mortgage today, or the next time they have to fix the mortgage in the future, those mortgage payments are going to be lower than whatever they were previously. So I think that improves confidence. That does increase demand from people wanting to buy property. The key thing I think that's important, though, is does that flow through to real demand? Can they actually borrow the sums of money required to buy the property they're interested in and pay the price that their vendor is willing to accept as well? And I think that's something that's been quite typical of a market that's typically at a turning point, is this does seem to be a bit of a standoff between the vendor and the potential purchaser as to what's an acceptable price. And because there's quite a few available properties for sale today compared to, say, the last year, so the supply is relatively high, not massively high, but relatively high. Demand is increasing, but not dramatically so, or real demand's not increasing dramatically so. We're still seeing a standoff point where that's not flowing through to truly increasing prices just yet. But I think we will start to see that flow through, maybe before the end of the year, and certainly throughout 2025. And then in terms of expectations for the OCR, look, that's exactly the question we get. What chance of a 75 basis point fall next month at the end of November, once the Reserve Bank meet for the last time this year? And I've done a bit more research into this because it is a question we get so often. I'm now leaning away from a 75 basis point fall. I'm pretty confident it'll be a 50 basis point fall. The main reason for that is that looking back over history, 2 decades of sort of history of the OCR, we haven't seen it fall by 75 basis points or more, other than in times of what I'd call emergency. So basically in the GFC, there was sort of a 6-month period, global financial crisis, when for 4 decisions in a row, the decisions were a 1% fall, it didn't move at all, then it moved 1.5%, and then 1.5% again. So 4% within 6 months, massive, right? But it was a huge emergency. We had these banks around the world going under, requiring massive support. We had interest rates falling to try and stimulate the economy. We had mass unemployment. And so, of course, interest rates fell in emergency to try and keep our economy as afloat as possible. So I'd say that was a global emergency, and why we saw such a dramatic fall in the OCR. And we did see, obviously, multiple decisions in a row where it did fall by more than 75 basis points. The only other time was in March 2020, which isn't that long ago, but if we all cast our mind back to then, it was, of course, when we first went into lockdown. COVID really hit New Zealand and around the world properly. The whole world was pretty much going to lockdown. And so once again, the Reserve Bank took the official cash rate from 1% to 0.25%. And there was all this consideration of, what if we have to go negative? What if this stalls our economy so much because we're all locked up, we need to go into negatives? But once again, it was a 75 basis point fall, but essentially in a time of unknown, no one knew what to expect. It was a time of emergency. Outside of that, we've just never seen it. And so I'm not ruling it out, because you never quite know. And there's lots of reasons for a great fall like that, to get closer to what's called the neutral OCR, which we think's in the low 3% somewhere. But I do think the Reserve Bank's going to be more conservative than that. They'll be happy to continue to step down through the ways to get down to that figure. And so I do expect them to just make that charge from 4.75% to 4.25% at the end of November. And then they'll get to see how that reacts, right? From that point, we then would have had 1.25% fall over the sort of last 3 or 4 decisions at that point. They'll wait and see how that plays out through the Christmas period, see what happens with retail spending. They'll be able to get a good feel for that when they come back in the new year. Another decision in February. And February, they can always cut another 50 if they need to as well, to get under that 4% mark. So that's my expectation. As we're always saying these days, it's definitely data dependent. There's still lots of data to come out between now and the end of November. We're going to get some unemployment data, which could be pretty bad and might encourage them to go for a greater fall. But we'll sort of wait and see on that one. That's where I sit at this stage. But certainly pending changes depending on what data comes out in the next few weeks or so anyway. But that's my sort of central scenario, I guess.
Well, that's pretty cool, and and good reasonings, and we'll if it is only 0.5, we'll go. We heard it here on the New Zealand Property Podcast, exactly. And the Go series by Nick, because it is the largest part of the year, isn't it? When there's no reviews happen. You said it's February, is it? So there's another 3 months between this one and
3 months.
One. Yeah,
that's right.
Okay, cool. Okay, well, thanks for that. Well, you've already sort of covered a little bit, but I'm interested in your words. So what do you say is happening in the property market? We're going, Nick, at the barbecue, what's going on at the on the property market? Is it good for buyers? Is it good for vendors? Or is it good for both? And I've got my own opinions on it. I don't give any bad news to some of my people, but
no. I think in general we're definitely in the same sort of basket as many people right now, which is that it is we're very much at a turning point in the cycle. Lowering interest rates is definitely a key cog that will get the market turning again. We've seen a number of changes, whether it's the last year or over a number of years, right? And they haven't had too much of an impact. And for me, the number one influence, the key sort of fundamental that drives this property market is the cost and availability of credit. And we know that the availability is improving, the cost is reducing. And so that is going to mean more people can get money from the bank, more people can borrow more money from the bank. And so you can pay higher prices. And as competition increases, of course, that means there's more demand for those properties. There's a bit more steam going. And so we see that competition drive higher prices through the market. But I think there's reason to also believe that it's going to be relatively contained. We know migration is slowing. Our economy is struggling. There's still job uncertainty for a number of people. So for those reasons, it's sort of just holding back this confidence or this potential boost that the lowering of the OCR could bring, which means that, yes, we'll see the end of the sort of mini downturn we're sort of seeing throughout much of 2024. We'll see the end of the downturn, but we're not expecting to see the market take off at a rate of knots like we've seen in other property market cycles before either. So we're sort of getting to this period where, we might see some growth before the end of the year. Next year, we might see some annual growth in the realm of 3 to 5% nationwide. But of course, as always, there's going to be differeces by region as well. And so maybe some of the larger centres do better than the smaller centres where the demand isn't quite as strong. Right now, the North Island has seen a larger lift in listed supply. So that might be something that holds back that value growth, whereas the South Island hasn't quite seen that. It's a bit more affordable too across many parts. So we might see a bit more growth come through in some of those South Island centres as well. So there's some pretty big generalizations there. And as you mentioned earlier, there's certainly no, personalized advice here. This is general market commentary. And then sort of, I'm never going to be able to provide probably direct information than someone would actually be able to get themselves if you're looking to buy, understanding that local market, what jobs have those people got in those areas. Those are going to be really core things to understand too. And people that live in those areas are going to know those best as well. So we can give that general overview, economic cycle, broader job experiences, where property market is, where the property values are compared to income. Those type of things are important. And no doubt things are starting to improve, but it's going to be pretty slow going from this point onwards.
Total agreement with you. I really, it feels for me back to probably about 11 to 13 after the financial crisis of 07, 08 sort of thing. It was 11, 13 was sort of just it was sort of just as a time recovery, but it sort of just stayed at a few little ups and downs, and we've seen that this year with we had a September last year to sort of January actually went really well. It felt good. Then it seemed a bit of a dip, and it did go down, I think 3% or something till about April, and then it seems just sort of going, starting to go along. There's certainly more sales, more transactions, obviously, which is good for us, but and the vendors, because they want to have their place transact if they sell. So it's not a great thing for me only. So yes, that's the thing. But as far as prices going up, I think we'll see wee many things, and it's interesting. We've seen I hang around with some of the best auctioneers in the country, and they've told a couple stories of like about 3 years ago where places have sold 200 or 300k above a reserve, but of course there's still a lot where people are dropping their pants a little bit to sell the property, and which needs to do, and that's sort of where it is. So for me, I actually, as an investor or a buyer, I actually really like this market. I have the last 2 cycles I've been through like this, because you can still buy well, but you can actually do really well with your sale of your property also, and that just depends, I guess, where it is. Is it, back to what you said before, there's not just one type of buyer, there's a numerous amount of buyers, and get your place ready for one of those people that want it. And that'll be interesting. We've got a couple out in West Auckland right at the moment, two properties we listed just last week, and one's the vendor's not listing, but it's a bit of a wreck. It needs a very big, probably 80-90k spent on not a great big place. It's not a reasonable bit of land, and people are loving that because the renovators are all over at the moment. There's some developers who actually like that. And there's some home buyers that want to come in and go, actually, I'm handy, I can actually do it because the bones of it are good. So, that one that you think, geez, no one's going to buy that, is really, really popular. We've got one about 200 metres away from that property. It's a wee 80 square metre sort of a property. It needs a bit of a tidy up, but it's not too bad. There's certainly not the action the other one's happening, but there is still people coming there where that property, I went back a year ago for now, no one would have been looking at it, because those buyers, first home buyers, etc., all investors couldn't get finance for it, but they can now. They're getting confidence in the market, so they're back. So it's a good time for both. It's, they say buy and sell, and they're both in the same market. It's okay. You don't really, lose, sort of thing. You can actually do that and actually do a little bit better if you play the game well right at the moment. That's my little sixpence worth.
Yep, no, I agree with all that, and I think that sort of goes alongside one of the things I talk to people about is, if you are buying an investment property, you're buying a property, and you think you want to sell it someplace in the future, the key thing is to make sure it appeals to the most amount of people, right? The more amount of people that are going to be involved or interested, then there's more chance of competition, and then they fight against each other to bid up a higher price, right? So I suppose it's about how you can identify that property that's going to be most appealing to the most amount of people in the future, and then you'll feel confident that it should be, valued, better, or at least very well in the future as well. So I suppose that kind of lines up with what you're talking about, that if the property's got some, ability to be seen as attractive to a number of different types of buyers, then that's going to stand it in good stead when you do go to market. So yeah, it makes sense for sure.
Yeah. As an investor, you don't buy that unique property. That's for you to live in, because it's unique and you want to live there. So that's all good. Another question is just I was brought up. I was a latecomer with property, to be fair. Only really lived and breathed it for 20 years, but I was a latecomer before that time. And I've seen a couple of property cycles, and over the last 5 or 6 property cycles, it's sort of been, the question is, you talk about the property cycle being 10 years and then you double and all those sorts of things, and it's been proven to be there for 5 or 6 lots, as I said. Is that still the way? Do you still see the property cycle doubling every 10 years? Because what I've seen in the last 6 or 7 or 8 years is government policy is what indicates the great ups and downs of property. Which sort of affects it.
Yeah. I think it's a really interesting one, but I'm going to talk about this because it's kind of a bugbear of mine. This whole property doubles every 10 years fallacy. Now, look, it might be true. It is true. It has happened before, but for me, it doesn't just happen because it happens, right? There's always a reason. And if you look through each of the number of the last, like you say, 3 or 4 decades, there's always been a structural change or a fundamental shift in something that has allowed that property values to double in that 10-year cycle. Now, whether it was, 20 odd years ago and we had the increase in double household incomes, so the fact that we had started to have 2 people work in a household, that meant our income grew massively per household, and suddenly we could afford to borrow more money. So that made a massive step change in the property market through that decade. Maybe prior to that, the other big step change was this fundamental shift in interest rates. We went from the average interest rate being 15 to 20% down to 5 to 8% maybe was the sort of norm. Now that shift can't happen again. We can't really double in household incomes again. I suppose we could start to become triple household incomes, maybe if that's 3 adults or it's a child living with the family and there's those sorts of things happening, but it's not going to become as commonplace as what it was back when the typically the wife, the mother actually started to go out there and get a second income for the household. And of course, the more you earn, the more you can borrow, the more you can pay for property, the more that shifts the property market up. So I like talking about it because it's a bit of a myth busting for me. Yes, it's happened, but it's always happened for a reason. It doesn't just happen because that's what property does. And that frustrates me. And I think now, of course, we're not going to predict what that fundamental shift might be in the next 10 years, but we do know that there's been some fundamental shifts the other way that could fight against that. Now, whether that's the debt to income limits coming in from the Reserve Bank, we saw through COVID, there was up to 40% of investors were borrowing more than 7 times their income. And that simply won't be allowed to happen again. So that's going to be something that would hold back any growth cycle in the future. We know that we're seeing a pretty massive shift in the way and the zoning of land. Now, again, it's not perfect, but we've seen it play out in Auckland with the unitary plan. Wellington's gone through something similar. Christchurch is a little bit different in that broader Canterbury area. But the cost of land is a huge part of why we've seen that strong growth in property prices over time as well. And now we're starting to see that shift where we are allowing more brownfield development, more properties, higher density in central located areas, as long as we associate it or align it next to infrastructure spend as well. So I think these big shifts do mean that we're unlikely to see that same behavior, 10-year doubling for decade after decade in the future. That's not to say it won't happen, maybe over 1 decade, and then it might slow down the next. But I don't think we're going to see it for the same reasons that we've seen that happen in the past either. And like any investment, I suppose, you're always, it's always important to say past performance isn't a predictor of future performance. And I think when we look long term, and again, I'm sure we probably said this 10 years ago, the 10 years before that, and would have been proved wrong if we did, to say that it doesn't look like the market is set to take off once again. That typically 10-year doubling, which is about a 6 or 7% annual growth rate every year, year on year. We don't really see that occurring in the next few years. Maybe that annual growth rate drifts lower to that 3 to 5% mark. Now, again, that's nationwide. It's sometimes meaningless because you don't buy a house in New Zealand. You buy a house in a city or a suburb within New Zealand, and they'll have different performance and behavior over time too. So I think that's an important one for me. But we do think that overall, that long-term growth rate is likely to be lower in the future than it has been in the past, unless, of course, we see another fundamental shift, and who knows what that could be, whether that's through monetary policy, whether that's through, household income, our economy, who knows, something will change. But for now, that central scenario says, unlikely to continue the way it has in the past.
Great. Well, I'm right on board with what you're saying there. Maybe I should be an analyst or something like that. But no, and maybe it's just been my maturity of learning property over such a long time. I get it now. But there has always been it's always been a fundamental thing, and some of those points were really, really, really important. With mum and dad both going out working, it's not likely to double again. I know there's some people in Auckland, the kids, which is very sad, the kids have to work to also to support the income for the family, which is bad. But the events like that aren't going to jump out very, very quick. We don't want another pandemic, so let's not even talk about that. No, that's great, and good to hear your views on that. So my opinion, and I think we both agree, and we just sort of said before, we're probably about the bottom of the cycle now, and we're going to go through some stage of recovery, which is great. And the first that's starting by buyers actually being allowed to buy or getting money to buy, which is good. And what my experience in the past is the lower price properties sell first. So probably the 2 cheaper ones I'm saying out west are a prime example of that. And then it goes up, and then the $1 million properties, and then the ones who are struggling at the moment, who own the 5 to 10 million plus properties, they're the ones that usually pick up when the market's about to go through a really big, a big up like that again, where before it all goes back to the start again. Is that you see sort of that's the same, or is it also come down to what you said before, the different types of buyers, or are they all relevant?
Yeah. I think in general that's true. I think certainly that bottom part of the market, we know it's a market that's attractive to a number of different buyers, kind of like what we talked about earlier, right? First-time buyers are going to be in that sort of lower to lower quartile to mid-range property. Investors are going to be looking to find value in that range too. And so as money becomes cheaper, of course, more people can borrow the sums of money and they can access those more entry-level properties, maybe around that lower quartile price. And so I think that makes sense. That one shifts first. That mid-range, as you say, maybe that's those movers. And so we probably need to see a bit more confidence in our economy, confidence in jobs before we really see that market turn over, where we see people upgrading the size of their property or moving to a fancier area. Those types of activity will take a little bit longer.
I'll just interrupt for a moment. It's really important. One of the movers you're saying, when that probably, we'll say in Auckland, that they're probably from the 1 to the 1.8 million or $2 million category, and then it comes down to, I guess, the supply of property. But then people, and this is a change of the phone things we all use. People are slightly different. They used to be 20 or 50 years ago, where you used to go out and paint the fence and mow the lawns and what have you. People don't like that anymore. So at the moment, for those movers, they want a nice property, and that's where some of those properties even now are selling, really, really well, and then some aren't. And then it comes down, I guess, the thing I love about property is so many factors in different markets and every part of it sort of thing. But generically speaking, I agree with what you're saying with the moves, that middle market.
For sure. And I think, whether they want to renovate, they do it themselves, or do they have to hire someone to do it? And then, what's the builder availability these days? It might be slightly better because we're not building as many houses. So there's more for renovation. So that could play into it too. The only other interesting thing I think there as well is that depending on where you probably put the elite market, there's probably an upper market, then an elite market. The elite market doesn't seem to really care about what's happening the rest of the cycle. And I guess people that are really buying the expensive ones, they don't care what's happening with interest rates. They're probably not really too fussed about that. They're probably massively wealthy. They've got massive amount of assets already, which have huge amounts of wealth tied up in it. And so they don't really get affected by normal property market cycles. They will be to a degree, of course. And if there's fewer million or billionaires, then maybe those properties don't do quite so well. But typically we sort of almost remove the elite part of the market out of it. But certainly the upper part of the market, those people that maybe are and depends where you are, of course, but might be 2s to 3s plus $1 million. Pretty hard to see those ones shifting depending on what's going on for those people and the jobs that those people are doing, and whether they're the ones that are upgrading or, where are they coming from? And given it's difficult to buy New Zealand property from overseas as well, often I think we'd rely on foreign capital to purchase some of these properties. And it's quite difficult for that to happen right now. So that sort of slows down the turnover of that market as well. So look, like you say, that's again, so for me, why I love being in this industry, because it is so interesting. There are so many factors to weigh up. It's never quite as simple as just saying what's supply and what's demand, and there you go. That should tell you what the property market's doing, because there are so many factors that affect those ones. But I think in general that's true in terms of the way the cycle will get going, and certainly the feedback we're getting, but maybe more anecdotal than real data just yet, is that that bottom part of those main centre markets are looking a bit more healthy at the moment and starting to move, and that'll flow through to the higher ones once we start to see the economy improve, and people feel comfortable in their jobs. That's when we might see that part of the market turn over more. So it's good.
No, that's right. And it's interesting you say about it's something I'd never really thought about too much, is the difference between the high end, the 3 to 10 or 5 to 10 mil mark, and the elite. The elite's in another category again. You're right, it doesn't really matter for them. But I guess what's hurting right now is that $3 to $10 million category. And I know some people that sell in that market and they're struggling right now. But I guess you think of what's gone on in New Zealand the last 3 or 5, or last 5 years since COVID. Those people were predominantly, or a lot of them are business owners and what have you. And of course, you look at the business, if you're into hospitality at all in the last 5 years, you've been through a hard time, and maybe you can't afford that $5 million home that you might have been able to afford once. And there's a lot of reasons why those places aren't selling at the moment. And again, when the time's right, that'll come back, I suppose. So no, good explanation of that. Well, I've kept you for long enough. You're a busy man, but just before I go, I'll just ask you if you're a first home buyer now, because there are more first home buyers, as you said now. I think 26%, I think, of the market that's what you said, of the market of first home buyers buying right now. Is that what that? Yeah, you're saying?
Yeah, that's right. Nationwide, that's right. 26.
So what's your recommendation for any of them at the moment?
Yeah, I think my number one is right in my wheelhouse, which is do your research. I think no one can beat learning it for yourself. It's all well and good to listen to me or listen to you or listen to friends and family or your broker or your agent, whatever it's going to be. There's nothing beats actually being out there and doing it. So go and look at Trade Me, go and watch some properties, go and see some open homes, see what you value and how that might differ to the market. Even let a couple of properties pass you by before you get a real feel for how you think the market values a property and how that might differ to you. Do you value sun more? Do you value off-street parking? Do you value the size of the house, the modern, the level of modernness of the house? All those things. You can't really beat going out there and getting amongst it yourself. So I think that's the key thing really, is to go and understand it, personally. And the other one, but I think in terms of a broader market, go and use the experience you've got available to you as well. I think particularly around the funding side of things, it is a pretty daunting prospect. So go and talk to, whether it's your local banker, or go and find a good mortgage advisor and talk to them about how it all works, because that's something you really want to understand really well. And you start to understand exactly how interest rates will affect how much you can borrow, how much your payments will be as well. And, are you willing to go right to the maximum you can borrow, knowing that your mortgage payment is likely to be lower in the future? Then maybe you can do that. Or are you one that's going to be more keen just to go, let's just buy a cheaper property. It's not going to be our forever home. Be flexible, I suppose, with your expectations. And maybe you're going to be in that house for, less than 5 years and look to upgrade that later on when, you will have built up some equity. Interest rates are, maybe not too much different than what they are today. You'll be earning more by then as well. If you're in your, late 20s or early 30s and you're looking to buy your first home, usually have strong wage growth through that period of time too, and things will only get better for you as well. So I think there's good cause to say, if you're ready to buy, then certainly go and buy now. Prices are likely to start to increase and interest rates will start to fall, so that makes sense. But similarly, look at your own finances and understand, what does waiting 6 months mean? It might still be a decent time to buy for you, and taking your time and understanding that market better for yourself will not be the worst thing either. So yeah, first thing, go research and talk to some people. That's the key thing for me.
Geez, great advice, well done. And yeah, and it's yeah, for me, you get your finance sorted, so know what you can borrow, because you're wasting your time in a way. I guess go and have a look at property to see what they're worth, and then whether you're ready to buy. But if you get your finance sorted, and now, as we're probably getting from this conversation, it's not a bad time to buy. Probably one of the better times in the last, we'll say, probably 4 years, I'd say. So yeah, that's great. Oh, wait, Nick, it's awesome having you on. I think we've been some wee gems out of this wee chat now. So I really thank you for your time. If you've been watching, had a couple wee hitches with him disappearing. It hasn't happened too much. So yeah, he's there right now. Yeah, so thanks for your time again. We'll get you on and get another couple of years, because I'm going to pick you probably be around then, if you've been around 13 years now. And yeah, thanks for your time.
No, thanks so much for having me. And yeah, certainly got no plans to go anywhere. So always on call whenever required. And yeah, there's no meeting or podcast done without a little bit of technical difficulties. So we're true to form, that's for sure.
All good. Thanks, Nick. For our listeners and the few watchers, thanks for your time today, and hope you've enjoyed the show. And we'll be back next time with an outstanding New Zealander talking something property. So in the meantime, have a great couple of weeks, and we'll see you then.
Ka kite.